Hey everybody, Luke Gromen, FFTT. Hope you are well. Use our sound effects here again. Thanks for joining me again today. Appreciate you being here. Always love these updates, as I always say. Can never say it enough. Really enjoy the interaction, the questions, etc. So thanks everybody for submitting the questions. We're going to jump right in the interest of time. So the first question, same question or a similar question from two different people, LB and RM. First from LB. Dr. Lacey Hunt is calling for disinflation. That seems counter to your call for inflation. Does he have a case? Second one, Lacey Hunt has predicted a recession and serious deflation. Does not appear to align with big print and inflation perspectives. How do you align or not with his view and or reconcile them? Is it possible? Does he have a case for deflation? Yes, if the U.S. government stands aside and allows Treasury auctions to fail and then continues to stand aside while the U.S. does not have enough tax receipts to pay entitlements and interest on the debt and starts to either cut entitlements or default on the debt, skip interest payments, then yes, he has a case. Of course, if they start skipping interest payments, it's probably not going to be great for his long-term Treasury portfolio. With that said, I think there's zero chance of either of those things happening, either cutting entitlements, Treasury auctions failing, and certainly not skipping payments on interest. And the reason I say that is right now with receipts at the federal level at all-time highs nominally, and with tax receipts as a percentage of GDP near all-time highs. So there's really not a whole lot we can raise tax receipts. The true interest expense of this country, the entitlement and the interest, the gross interest, is over 100% of receipts. So we are not covering the interest in the interest-like obligations that are due out of receipts. And so that's why I say, yes, if we're willing to stand aside and let Treasury auctions fail and let entitlements be cut and possibly let Treasury coupon payments be skipped, then yeah, we would have the worst deflation. I don't know that it would be great for Treasuries though. Number one, they would be getting coupons skipped, and who knows what that would make. I don't think that's going to happen. But more importantly, and less dramatically, less hyperbolically, empirically, we can see over the last 5 years repeatedly what has happened, which is stocks fall on deflationary fears. Treasuries are bid, long-term treasuries are bid. In other words, long-term treasury yields, 10-year treasury yields decline for a little bit. And then 5 to 10, maybe 15 trading days in, stocks keep going down, and yet 10-year treasury yields stop going down and start going up. We've seen this over and over. We just saw it again at the end of February into March and during Liberation Day. We saw it last summer. We saw it in April, May 2024 for a moment. We saw it in 3Q23. We saw it in 1Q23 with Silicon Valley and Signature Bank. We saw it in 3Q22. We saw it at the depths of COVID in March. Yes, that was sort of one of the first big instances. 10-year treasury yields did go down a lot at first, and then they started spiking, even as stocks kept falling. There's a couple issues. Number one, from a structural perspective, net capital gains plus taxable IRA distributions alone are 200% of the annual growth in personal consumption expenditures. In other words, 200% of the growth in consumer spending is net capital gains plus taxable IRA distributions. That's stocks. Then you have incentive comp for executive. That's taxed as ordinary income. That's another big chunk of money. The punchline is U.S. consumer spending cannot grow mathematically if stocks don't rise. And if consumer spending doesn't grow at 2/3 of GDP, GDP can't grow. So the linchpin in the whole thing, the keystone, the bottom Jenga block in the whole thing, the whole economy, stocks going up. And so if stocks don't go up, if they start going down, initially there's a flee into long-term treasuries, as has sort of always worked up until about 5 years ago, before debt got too high, before deficits got too high structurally. Now, You get a brief moment where yields go down with stocks, but then there starts to be concerns about what receipts are going to do. Rightfully so, because if stocks go down and stay down, receipts are going to go down. And we're already not covering the interest and the entitlements out of receipts. And that starts to be, that's the structural reason why treasury yields now go up if stocks go down too far too long. From a mechanical standpoint, the issue is going back 11 years, foreign central banks have not bought any new treasuries on net in 11 years. One of the biggest marginal buyers of treasuries has been, in recent years, has been highly levered hedge funds via the basis trade. And so the way these hedge funds work, practically speaking, it's an oversimplification, but basically when volatility goes up anywhere in their book of business, in their book of assets, they start delevering across the whole thing. So if equity volatility goes up, treasury vol starts to follow a few days later, because what happens is, we're levered across the book, various levels. Vol goes up in one portion of the book for whatever reason. They start to degross across the book. What do they sell? They sell treasuries. They delever treasury. The basis trade that they have on with treasuries is very highly levered. That's mechanically a big part of why we've seen it. And to the extent it's gone on longer than that, U.S. banks were regulated into buying treasuries as regulatory capital, et cetera. So if it went longer, that would be an issue. The bigger issue, when it's gone longer, is when the dollar has been too strong. Foreigners own $8.5 trillion in treasuries. And so they are short dollars in terms of their dollar-denominated debt, but they're not short dollars in aggregate. They're just holding the dollars in the form of treasuries and U.S. stocks. And so if they need dollars to either defend their currency against a stronger dollar or buy oil or finance current account deficits, they sell what they can. They sell U.S. treasuries. And so that is ultimately why, even with recession, like if we get a recession, if Dr. Hunt is correct and we get a recession, sure, would long yields, 10-year treasury yields go down for a little bit, a couple weeks, maybe even a whole month. But then they're going to go up, and that's going to blow people's mind. Why is that going to happen? Simple. U.S. fiscal deficits are 6 to 7% of GDP now with no recession. Last 3 recessions, deficit to GDP went up 6% of GDP, 8% of GDP, and 12% of GDP. That's going back the last 25 years. Well, if we let's throw out the 12% because that was a pandemic, a bit of a one-off. Let's use 6% or 8%. At 7% deficits, that means the deficit is going to 6 plus 7, or 15%, 13 to 15% of GDP, 7% plus 8%. That's a lot of supply. And oh, by the way, it's going to squeeze the dollar higher. So no foreigners are going to be selling on top of that too, maybe another couple percent. So the effective deficit might be 15 to 17% of GDP. And then let's factor in banks might be selling maybe another percent of treasuries to raise capital to offset credit losses in said recession. So we're up to what? 16 to 19% of GDP, 17 to 19% of GDP in net effective treasury issuance? You think, I would encourage anyone to ask Dr. Hunt. Dr. Hunt, do you think long-term treasury yields would go down in a recession where deficits are 16 to 18 or 17 to 19% of GDP? I dare say, I think he would say no, they would go up. And if they went up, I think he would say yields would go up. And the only way they would go down would be if the Fed was buying to cap the yields. Well, the only way you can get yields to go down in a recession is if the Fed buys them. Why am I buying duration? Why do I want to hold my duration in long-term treasuries versus in gold, which can actually respond to that money printing, or in Bitcoin, which can actually respond to that money printing? That is ultimately why I disagree with Dr. Hunt on that and have for some time and will continue to. Next question from MNTS. If the U.S. needs structurally high deficits to avoid recession, but those deficits require the Fed to cap yields via yield curve control or some other form of liquidity or maybe treasury, do you see a scenario where housing gets reflated, not because it should, but because it must? In other words, is the housing market a casualty of fiscal dominance or a policy tool to preserve it? It's a really interesting question. It's a good question. In my opinion, housing in a negative real rate environment probably benefits from those, negative real rates. In other words, rates below inflation. I think it probably benefits from what would result in terms of higher nominal wage growth. Um, and then higher stock prices. Negative real rates are very good for stock prices. And ultimately, we have seen in recent years, boomers and the remaining silent generation, they've got whatever it is, 75, 80% of the wealth of this country. As that paper wealth goes up, we have seen them buy houses either for themselves and or for their kids. And that translates into higher prices for houses as well. So I ultimately think that would continue. I would think that sort of the structural situation we are in, which is that the United States government over time needs significantly negative sustained real rates, sustained significantly negative real rates, more accurately. That's ultimately, I think, I think it's a solid environment for housing. It's probably going to be regressive. It's better for the older, wealthier buyers, and the children have said older and wealthier buyers. I'll leave the social commentary aside to that. It just is what it is. So next question from BN. Luke, how can we compete with China on raw materials that are mined and enriched at much lower costs there versus here, with mines getting online and now running out of stockpiles while China limits exports? Are we screwed? The way we can compete, it's really one of two things. We can have a lower currency, lower dollar versus the yuan, or we can have higher productivity overall, and particularly in the mining sector versus the Chinese. Practically speaking, given regulatory constraints here that aren't as big an issue, if at all, over there, if we want to compete, you got to have a lower dollar. That's it. Full stop. End of story. And that would be inflationary, all else equal. From David Carroll. Hi, Luke. Great work coming from you as always. Thank you very much, David. I would love to hear any thoughts you have top of mind related to AI, anything that has grabbed your attention recently. So, as you know, David, I've talked publicly. I've talked, certainly in writings for clients. Was at a private conference earlier this year with a number of different AI-related speakers, and got a chance to speak with them one-on-one after the presentations. And we all kind of agreed that it's AI, as it's being discussed and rolled out, is simultaneously the most exciting and horrifying thing I've seen in my career. And I've been doing this 30 years now. It has the chance to drive massive, massive productivity improvements, quality of life improvements over time. And the disruption between here and there is massive. I mean, a couple of these AI speakers at this private conference were saying in the AI and sort of VC venture capital sector, there's a lot of people saying within 10 years, the top 20% of people in a lot of professions are still going to have jobs, and the bottom 80% are going to have to figure out something else to do. Our society is simply not geared for that level of change that fast. And, the other thing within all of this is I continue to hear that massive acceleration in electricity consumption, massive growth in electricity consumption around AI, and an electric grid in the United States that is nowhere near ready for the level of growth that it's seeing within a few years, and an electric grid supply chain that is nowhere near ready to grow the capacity at the pace that AI is growing its consumption of electricity. So we're quickly running into a bottleneck there, which again, it's going to set up for weird things possibly, right? Do we want our hyperscalers and our AI data centers to run and compete with China, for example? And that's what we want to do. Do we want to have brownouts in parts of the United States because AI is consuming that much 2-3 years out? Can we roll out the requisite levels of nuclear power fast enough, connect it to the grid, build out the infrastructure? We know what we need to do. Everyone knows what we need to do. The questions are, one, can they get elected after they do it? And two, or get reelected after they do it? And two, can we anesthetize the bond market and convince the Fed to help us anesthetize the bond market to basically cap yields to prevent rising yields from what is likely to be accelerated inflation if we do what we have to do executionally to build the grid to support all this. And from an executional standpoint, there's a lot of risk, and it's not clear it's all going to go really swimmingly because we're on the clock. This is coming really fast. the thing I guess I would finish with on that front is every time I hear something from people in sort of the AI world, if you will, I'm left with the continued reinforcement of, I think, maybe the most important thing to grasp as a tourist, which I am and which is a lot of people are to that space, which is our debt-based monetary and banking system is fundamentally incompatible with the pace and level of wage deflation, job deflation, productivity growth that AI could very well bring. And what does that mean? That means paradoxically, maybe the cleanest plays for the average portfolio as it relates to AI is to have a chunk of gold and have a chunk of Bitcoin in there. Because ultimately, what does fundamentally incompatible with debt-based system? Look, let's say these guys are 60% wrong. It's not the bottom 80% that have to find something else to do. It's the bottom 60% times 40, so bottom 48%. So it's the bottom 32% of workers, right? The other 40% times 80%. These guys are 60% wrong. So the bottom 32%, not bottom 80%, need to find something else to do. If the next offer for the bottom 32% across a wide array of industries over the next 10 years needs to find something else to do, that's a lot of home mortgages that are going to default. That's a lot of credit cards that are going to default. Car payments are going to default. Student loans are going to default. And by the way, student loans can't be discharged. Medical school loans. This is no longer an issue for just the middle, the middle class, the working class. This is now, this is what China did to the working class in the 2000s. AI is going to do to the white collar workers and medical administrative and medical doctors later in the 2020s and into the 2030s. And so when if this plays out the way a lot of people in AI think it could, when they stop making payments on their debt on the margin, and again, it doesn't take a lot of people defaulting on their debt. It doesn't have to be 32%. We saw that in 2005, 6, 7. It takes a small amount. The leverage is inherent in the system. It's a debt-based system. It starts feeding on itself. Then the central bankers are likely going to have to make a decision they've repeatedly been faced with over the last 17, 18 years, which is print the money or let the system come unwound, let banks fail wholesale, let deposits be threatened. And we know the answer to that one. We know it. They're going to print the money. And that's why I say for the average tourist, for the average investor, maybe the easiest, cleanest way to play AI is just put, 5%, 10% of your money into some blend of gold and Bitcoin, depending on your risk and volatility tolerance, and just let it sit there for the next 10 years. Because ultimately, if AI and automation keep doing what they're doing, it's going to break the debt-based system. And when it breaks it, we know the reaction. We know it's going to be print the money to maintain the system. So all credit for that original line of thinking really comes to my friend Jeff Booth. If you haven't read his book, The Price of Tomorrow, it's a must-read in my opinion. From Brian L. Luke, I'm interested in the reasons you feel U.S. equities will return 10 to 15% going forward, given how high the PE ratios already are. I understand the need for the U.S. government, Fed, Treasury to prop up stocks to increase tax receipts, but would like a bit more detail. I think it's important to look at the PE ratios of stocks relative to the PE ratios of treasuries. The risk-free rate in all of this, the treasury bond, let's look objectively at U.S. Treasuries. The U.S. Treasury has not turned a profit. They've not run a surplus in 24 years. They have offshore balance. They have debt at $36 trillion. They have receipts of $5 trillion. So $5.2 trillion of all-time high receipts. Let's just use $5 trillion, $36 trillion of debt. So they have debt to income what is that? 36 trillion on 5 trillion. So that's it's 7 times. Excuse me. No, it's 7.5 times. 7.2 times to be accurate receipts. So you have debt to income of 7.2 times. You have off-balance sheet liabilities of probably about $100 trillion or 20 times. 20 times all-time high receipts. You've got a political situation domestically. How's the leadership? How's the executive committee of Corporation USA and its U.S. Treasuries? I don't care which side of the aisle you're on. The last 8, 12, 22, 24 years, not so hot. Not so hot. So ultimately, critically, this all then ties back to number one, let's look at it comparatively. What's the multiple, right? Yes, stocks are expensive, but at least there's some there, right? They haven't lost money for 24 straight years. And I know the purists will be like, oh, that's not the right way to look at it. Markets don't care what you think. It's all relative. And so, right, so our risk-free asset is now finally rated AA by everybody, but on its merits, it's probably a junk bond. And if that's your risk-free asset, and the risk-free asset underpins every other asset, that suggests the valuations of everything else should be higher from that. Okay. But then it does. We know, as we highlighted earlier, the stock market basically backs the treasury market. This will all come unhinged if stocks don't go up, because they need stocks to drive the consumer spending receipts that drive the GDP, that drive the tax receipts that back the treasuries. And if stocks go down, that's the Jenga block at the bottom of the whole thing. This is the system they wanted, and now they're getting it. And so ultimately, as I touched upon earlier, look, treasury auctions, you get stocks down and they stay down too far, we've seen it empirically, repeatedly for the last 5 years. You will see treasury dysfunction. If they don't supply the liquidity then, i.e. that will drive stocks back up, then you will see treasury auctions get very sloppy. They will ultimately, again, if they continue to stand aside, they would fail. I don't think that's ever going to happen, but that's mathematically what would happen. And so, we can see this again empirically, 2020 to 2022. 2020, we finished the year with what? A $3.2 trillion deficit, fiscal deficit, 3.1. 8% inflation CPI, and I want to say the S&P was up almost like 50% year on year. Voila. We were down to $1.4 trillion deficit by the end of fiscal 21, end of fiscal 22, right? So you had 2 years of 8% plus like 50% and 20 or 30% CPI, or excuse me, year-over-year growth in S&P, not CPI, S&P. And voila, we have the deficit of the United States goes from 3.1 trillion and to 1.4 trillion, fiscal 2020 to fiscal 2022. And then the Fed's rate hikes start catching up. Stocks go down 22%, just 22% peak to trough over 4 months in 2022 and into early 2023. 22% peak to trough decline in the S&P in the grand scheme of history is nothing. It used to happen like once a year, maybe once every 2 years. But fiscal 2023, the deficit went from 1.4 trillion to 1.9 trillion. With unemployment staying very low, with GDP staying good, not great, but good, certainly no recession, just having stocks fall 22% led to non-withheld receipts. That's the incentive comp portion that goes to ordinary income, as well as some of that other stuff. $500 billion shortfall, 2023 versus 2022. Stocks. It was stocks. So that's why I say, is 10 to 15% up a year the right number? That is sort of a Texas hedge guess, if you will. It's probably roughly that, but it depends on what's inflation, if inflation's running much higher than that, that number could be lower. But ultimately you sort of need that type of S&P number in order to drive the consumer spending, to drive the tax receipts, to support the treasuries. Otherwise, like I said, the stock market is really the Jenga block at the bottom of the whole tower, and you pull it out too far and it'll all come down. So it is somewhat intellectually offensive, but again, thank our leaders post 1995. Clinton, Bush, Obama, Trump, all of them. They're all this is their doing. This is how they set the system up. This is what they wanted. And then the final question from MN. One of the conclusions in the Lords of Finance book, great book by Liaquat Ahmed, is that the return to the gold standard to stabilize currency proves disastrous as it restricts economic flexibility. Do you agree with this, and how how this relates to using gold as the neutral reserve asset? So I disagree with it. Ultimately, the issue was the price of gold relative to currencies and their underlying fundamental economies, the economy's fundamentals. Um, for example, and by the way, the countries in question in that book, he does note, Liaquat Ahmed does note in the book, they didn't abide by the true gold standard. So, for example, the U.S. was being flooded with gold through the 20s. They should have, the U.S. should have been slashing rates. Get that gold out of here, basically, right? Europe should have been tightening like crazy. That's where it was restrictive, but some of that was because they never set the gold price properly, right? The British wanted to try to go back to the gold standard, the pre-war parity of 1914, even though they run up a ton of debt fighting World War I. Well, of course gold's going to crush them. They needed to reset the price and just basically, inflate it away. The other issue is, I think, ultimately a fixed price gold standard doesn't work. That I would tend to agree with. I think it makes more sense to have the price float, the neutral reserve asset float. In other words, when you have it fixed as they did then, to a unit of fiat currency in the case of Britain and the U.S., that is extremely restrictive. But if you have the price float, where the price over time of gold is going up basically in all fiat currencies, and then based on the realities of trade, productivity, etc., fiscal deficits, relative interest rates, the price of gold moves around and moves around in different currencies, then it's not as restrictive. It is still restrictive, but that's called discipline. And the alternative is what also happened there. You had, the five industrial powers after World War I. You had America, Germany, France, Russia, Japan, and Germany. I'm putting in the Austro-Hungarian Empire kind of lumped in with that, which may or may not be fair, but the Americans had a severe recession in 21, I want to say. It was brief, but it was really bad. Jim Grant wrote a great book about that. France devalued the currency multiple times. The Germans hyperinflated the currency to basically zero. The Russians hyperinflated the currency to basically zero. The Japanese had a severe currency deflation as well, or currency devaluation as well. Britain initially had deflation, and then ultimately they devalued. So, there's a discipline that would be instilled there as a neutral reserve asset, but critically, if the neutral reserve asset is floating in all currencies, it's going to be a level of discipline, but it's also going to get rid of the imbalance. It's going to rebalance the imbalances over time that have been allowed to develop, right? So we frequently hear, well, the Chinese are mercantilist. Well, yeah, they have to be in this system. Well, the Americans run all these deficits. Well, yeah, we have to be with this system. We have to offshore our entire industrial base. It's not working for anybody anymore. So I don't think the solution is the pure fixed gold standard of Lords of Finance. I think the solution is a neutral reserve asset that floats in all currencies. So basically, gold's going to go up in everything over time, but it's going to go up less in yuan than it is in dollars, because we're running much bigger balance of payments deficits. So hopefully talking through that a bit helps. But if you haven't read Lords of Finance, I definitely would. It is an incredible book, very well done. I actually had breakfast with the author, courtesy of a client, probably 7 years ago. It was a very fun breakfast to kind of talk through that book with him, Liaquat Ahmed. So with that, I'm going to finish up. Thank you as always for joining me. I really enjoy these conversations. If you like these conversations, check out FFTT-LLC.com for more information about our Tree Rings product. 10 most interesting things. Brief synopsis about what grabbed our attention about each of those things and whether that new development is either reinforcing or changing a way we'd previously been thinking about the world. So thank you very much, everybody. Everybody have a great rest of your week and enjoy the start to your summer. Take care, everyone.